So this is we are going to cover today crude and treasuries and also our outlook on rupee. So first we'll talk about crude. Now, most of our clients are familiar with our monthly dollar rupee reports. We also have been publishing monthly crude reports since 2018, and this is our reliability so far. This is our monthly September crude report. I'll just take you through the structure of the report and then I'll take you through the main things that we've covered. So first page is the technicals of the crude market. Second page, we have looked at crude along with the US and global growth indicators. The third page is the internal dynamics of the crude market, the backwardation and contango, and the inventory levels. Then fourth page is the global demand supply position. This is shared every month. And then the fifth page is small or whatever news that we got to keep an eye on. So now I'll take you through the main points of the report. So first, if we see this, the pink line is the consensus growth projections for 2019. The actual so far it has come out as 2.72. The growth projections for 2020 were going at around 2.75, 2.81 in March. And then with the COVID, the growth projections have fallen off sharply, and the global growth projections now are currently around minus quarter percent. Some may say around minus 3%. But the consensus is what we've taken. At the same time, the 2021 projections are in the positive. So basically, everyone is looking for a good recovery in 2021. And when we look at global growth, which is the green line, with we juxtapose that with changes in the annual changes in the Brent prices, we see that there's a very good correlation between the two. So right now, of course, the global growth having fallen to minus quarter percent. So 2020, the Brent price would be falling to around minus 31. There's a 31% fall in Brent, if at an average of 43.84, which currently it is 42.94. We've taken an average of 43.84 for the whole of 2020. Assuming that global growth recovers to 4.35% in 2021, then we can assume that Brent will also increase, and there will be a 26.12% increase in we're assuming in Brent, which will translate to about $55 on Brent. This, if we compare with, say, the US IIP and WTI, so we see that there's a decent correlation between the US IIP, which is the blue line, and the WTI, which is the pink line. So after, this is not actually Y2K, but maybe after Y2K, the 9/11, that low, and then the GFC low, and then we've got the COVID low. So with these, whenever there was a decline, then there's been a sharp recovery, and we're looking for a similar recovery in the IIP and the WTI now. Same thing can be seen in the US retail sales after GFC. The US retail sales declined sharply and then recovered. And similarly, the WTI also fell and recovered. So now we've already seen that the US retail sales has already gone into positive, and we can now expect it to remain in the positive in the region of, say, 2% to 6% over the coming months. So there will be a steady rise in US retail sales. And along with that, we can expect WTI also to rise. So this was the position. This is what we expect in crude with relation to the uh, growth figures. And coming to the internals of the market now, of the this is the red line is US crude stocks excluding special petroleum reserves. So when this we see that the uh, inventory, crude stocks inventory is falling, and the WTI prices are rising. As you can see that generally there is a negative correlation between the two, which is a bit self-explanatory. When the stocks are high, then the prices are low, demand is low. And when the demand is rising, then stocks will be drawn down. And that is reflecting in the price now. If we look at the global demand supply position, this is $1 million per day. Demand is come down to 93.14, but is expected to go up to 100.17. Whereas and supply has also come down to 93.58, and then 2021 it can go up to 99.36. So if we see that demand at 100.17 will be higher than supply at 99.36, which is about 0.81 million barrels per day difference excess demand next year for 2021. Currently, this is there's a excess supply position for 2020. So we've got a projection. Sorry. So we've projected, and this is OPEC or EIA projections for the demand supply. So it will be positive. The demand supply position will remain positive through 2021. This is the internals again of the crude market, the backwardation and contango position. Contango is when the futures prices are above the spot prices, and backwardation is when the futures prices is below the spot price. And here we've compared the 1 month and the 12 month. So 1 minus 12, when it is negative on the right hand axis and the blue axis, this is contango, which means that the 12-month prices are higher than the 1 month prices. And here in backwardation, the 1 month prices are higher than the 12-month prices. So basically, when the market goes from contango to backwardation, if you see this period from February 16 to August 18, the market is the difference has gone from contango to backwardation, and the WTI price has also risen in that time. So what this indicates is that the near-term demand is increasing or decreasing, and that gets reflected in the price. This we can see the current futures curve of the WTI. So we would expect if the previous chart moves towards backwardation, then the 1 month will rise relative to the 12-month. So, and that will be reflective of immediate near-term demand, which will then reflect into price, or will be driven by price. If we take a very long-term view of the market, this is a chart that we've been working with for a long time. This is since 1861. On the left-hand axis, we've got gold. These are log charts, yearly average log charts since 1861, gold, and on the right-hand side, we've got Brent. And you can see the very good correlation between the two, especially since around 1930, around the 1930s. Now, the, we can expect gold to go up to yearly average to go up to about 2150 over the next say 2 years. So crude can work for about another year. The current bounce from crude can go up for say 2021 and then maybe even a bit of 2022, and then we would expect gold to come down and crude also to come down. So in the very long term, 3 to 5 years, we could see a dip in gold and crude prices. If we see the immediate near-term chart of crude, then we've got Fibonacci supports at 39.70, 39.32 as one support region, and then 37.5 and 35. So the current dip has been holding so far about 39.32. We got to see if it continues to hold and moves up immediately from here, or it goes down to 37.5 or 35, but we would not expect much lower than 35. Our long-term view would remain bullish towards 50-55. If we look at the Brent and WTI spread ratio also, we see that the spread has come to low level of $2, and it can possibly rise to 6. And the correlation between Brent crude and the spread is negative right now, and this correlation itself can rise, which means that when this correlation rises and the spread itself is rising, then Brent can rise. So in summary, I'm making this a little short, but I'll take questions. So Brent and GDP growth have high positive directional correlation. Higher GDP estimates for 2021 is indicative of a rise in crude over 2021. Okay, WTI, US retail sales, US IIP, other indicators also move in conjunction. So recovery in these will indicate it will be positive for crude. And the crude inventory is inversely related to crude prices. So fall in inventory levels is positive for crude. Rise in demand supply is negative. So we're seeing that there'll be excess demand according to OPEC and EIA in 2021. That should be positive for crude prices. The crude future spread is in contango just now in the near term, but it could move towards backwardation in the several months ahead. And long-term directional correlation between gold and crude. So when gold or even with Dow, so when these rise, then crude can rise. And correlation between Brent and WTI spread, that also indicates that the Brent could rise. So these are the main points that we had for crude. So I would be happy to take any questions right now that you would have for on this on crude, and then afterwards we'll move on to US Treasuries, and then we'll move on to further into. So I'm open for questions, please, on this, on the crude part.
Hi, Vikram. So I understand that you're looking at a max fall to $35, right?
Yes, yes.
What do you need to see for you to change that view? What could take Brent all the way down to 30, let's say?
Okay, so we want to see a massive decline, say, in the Dow or in growth, or we need to see, say, another lockdown. Say, Israel has gone in for a lockdown. So something like that happens. Then Austria is talking about a lockdown or a second wave, stuff like that. So if those things happen, yeah, then we would have to think of lower prices. So basically, if economic activity stalls, if economic recovery stalls, then.
So on the technical charts, if there is a 5, would that? Yeah. So on the technical charts, if there's a weekly close below 35, would that be a bearish enough signal for you?
I would assume so. Then I mean, I hope that we'll get signals before that itself that things are worsening. So hopefully we won't have to wait for 35, but yeah, and then we got to look at how much below 35 do we go? Do we go to 30? Do we go to 25 or something? So yeah, but definitely below 35, I would not want to be long in the near term.
Okay. Okay. Yeah. Thanks.
Thank you. Any Ghanshyam Masraji had a question, I think. So Ghanshyamji, would you like to ask a question?
Hi.
Yes.
How are you evaluating the supply side of impact on the crude prices? Because as of now, the kind of base which has been created on price is more driven by the supply than by the demand.
Mm-hmm.
And now with OPEC looking to let go of the supply cuts,
Mm-hmm.
will that not have an impact on the prices outside technical charts?
That could have. In fact, I think so, the Saudi Arabia, the Saudis relaxed the production cuts just now. So we have that in mind, and that will reflect in the prices. So we've got the support region anywhere from 39 to 37, and then 35, and we'll have to see. So just the cuts by themselves will not. I mean, sorry, the going back on the production cut will on the supply side will not be enough to take it below 35. To take it below 35, we'll have to have supply increase plus economic, I mean, demand destruction. So
Mm, if I recall correctly, in 2014, the total demand destruction, or rather not the demand destruction, the oversupply in the crude market was expected to be around 2 to 3%.
okay,
And once OPEC decided not to intervene and reduce production or have production cuts, prices fell from the close to hundreds to the 30s. Today, we
okay.
are talking about a demand destruction of almost close to 9 million barrels per day.
Mm-hmm.
With that sort of a demand destruction, supply cuts not being managed,
Mm.
the impact could be far larger.
Yeah, it could, but at current, at current prices, the current economic situation and the current supply position is taken into consideration at current prices.
Hmm.
If the scenario changes, is when we'll see prices change, right?
But the
So
but the concern is for us. I mean, being from polymer industry, from 45 to 40, market has not reacted.
right,
But the moment market starts believing that it's not going to stop at 40 and it's going to probably move lower,
hmm,
the overall impact will get factored in immediately the
correct.
moment there is conviction. So we
You're
cannot wait for 35 or 37 to happen and then realize that okay, it's going to fall lower. We need to predict that now.
absolutely, you're absolutely correct. So we had the 39. So the first thing is that we have some technical levels in place, which is 39 and 37 and the 35. Now we saw an initial bounce from 39 to 40, and then we're dipping a little bit again. So if it now happens to fall below 39 over say today, tomorrow itself,
Hmm.
after say the FOMC, then that is the first red flag and the red signal immediately. So we'll keep that in mind. And if it happens to break below 39, then we'll say that maybe yeah, it's going lower. So it's not that we'll wait for 35 to break and then go bearish.
That's it. Thank you.
Thank you so much. Uh, any more questions on crude? If you don't have any more questions on crude, then I'll move on to the US Treasuries. So now I go on to US Treasuries. So this is another report that we make every month. Now here we have the last FOMC, and then of course we have FOMC today, tomorrow. The last one they talked about that the average inflation targeting, where the Fed is ready to tolerate inflation of 2% for a fairly long period of time. So if we compare this period after the post GFC period, the CPI, core CPI fell to 0.6% and then rose to about 2.25%, fell again to 1.5%, and it on average, the black line is the 12-month moving average. On average, the inflation did not really go above 2% for an extended period of time for a period of 5 years. So if this sustain, if we have a replication of this period, then maybe we're going to have low inflation for a long time. They think that we're going to, and if the inflation is going to be relatively, low and not go up above 2% in a meaningful manner, then yields will continue to be low. So that is something that we will examine in this, and then we'll try and see what how it relates to yields. So here we have a study of the US headline CPI, which is the pink line, and the year-on-year changes in WTI. And we see that there's a very, very good correlation between the two. So keeping in mind our bullish view on WTI, we project the green line, the annual change in WTI over the next, say, 12 months. This is part of our crude report. From there, we have taken this, that we're looking at, say, 50, 55 if we talk on Brent, then that really can translate into this kind of a trajectory for the year-on-year change for WTI. If that happens, then the US headline CPI, we would have to budget for, say, 3.5% over the next, say, 6 months or 9 months or something. This chart is juxtaposes or compares the actual core CPI, which is the blue line, and the current 10-year US break-even inflation rate, which is the pink line, and the US Treasury, which is the red line on the right-hand chart. So we see that if, the US 10-year inflation rate, break-even inflation rate is around, it's around the 1.5% or so. But if we expect, as from the previous chart, if we expect the US headline CPI to go up to about 3.5%, then the core CPI we would have to budget for about 2.75% or so. So if that happens, then the break-even inflation rate would also move up to around 2%. By this, it might seem that the yields would go up. But if we look at the 30-year, the chart on the US 30-year, we have a triangle formation out here. And if this holds, then we can have an immediate decline in the 30-year. And if in case yields have to rise, then the 30-year can go up to, say, around 1.7, from 1.4, say, goes up by 30, 35, anywhere between 25 to 30, 35 basis points, and then falls from there. So I'm looking at the 10-year, the same triangle, the same triangle formation of on the 30-year, if we take it onto the 10-year, then yes, then there can be a decline from current levels itself. Or if we look at this black line as from classical charting, then this black line has been broken, and maybe the US 10-year can go up to about 0.9% or maybe even up to 1%. So if we are at around 0.65, allowing for, say, 30 basis points on the upside to correspond with, say, 1.7% on the 30-year, that would translate to around, say, 1% or so on the 10-year. So this is the less preferred view, and the more preferred view on the technical would be that the US 30-year falls immediately, and the US 10-year also doesn't go above 0.7%. Because having why we would assume that yields do not go up, of course, is that I would assume that the why when the Fed has said that they are going to be tolerant of inflation about 2%, they have this in mind that, say, currently the current recovery that we are seeing in not only CPI but in all the economic indicators, we already have a V-shaped recovery compared to which is faster, much faster than what we saw during the GFC period. So the we could have, even if we have the CPI go up to 2.25%, the Fed does not want to be forced into raising rates. So they have already taken into or discounted the possibility of the CPI going up about 2.25% in the nearer term of the next, say, 6 months or 12 months compared to the earlier period of GFC. So this is some, because if we are looking at crude going up, I'm sure that the Fed would also have made such calculations. So that is why they are, if they're going to be tolerant of inflation of 2%, 2.25%, that they've said will still they would not need to raise rates. And if rates don't rise, then yields can fall. So we're going to have the FOMC today, tomorrow. Market will be possibly wanting to see whether they stick to what they've said, and therefore can yields fall immediately is what we'll get to see over today, tomorrow. Again, this was a short thing on take on US Treasuries. So, any questions on this? And then I'll move on to say the rupee.
This is MN Rao.
Yes, Mr. Rao.
The thing is that people are talking about the negative interest rates also, and if you see that these countries are talking about the negative interest rates. But in your projections, we are expecting that interest rates will be come down to in this scenario at this 40 basis points for 10 years, and it may be move up to 100 basis points. But
can you repeat?
Downside you consider it may come down up to 40 basis points. Upside it may go up to 100 basis points.
Okay.
No, actually that's why even many countries they are giving the stimulus packages and that liquidity is changing too much in the everywhere. So in that scenario, but you are talking about only means is there any chance of that US Treasury may go to the negative means at least zero interest rates or negative interest rates at all?
I will share the long term. This is on our website. If we look at this chart of the US Treasury yields from 1993, so we see that there is a secular downtrend. If we extrapolate on this, there seems to be very little chance of yields really going up into the 30-year going up into the 3% or 3.5% region. Rather, as we said that we would expect resistance at 1.70 to hold on the 30-year. If the resistance holds at 1.70, the 30-year is likely to come down over the next 12 months or 24 months towards 0.75%. And the 10-year would go down towards 0.25%. And eventually, I would not be surprised if it goes towards 0%. Whether it goes into the, and I'm talking about the yield out here, I'm not talking about real rates at the moment. But the US has room to go down to even 0%. And if we are talking about crude going down structurally over the next 3 to 5 years, then there seems to be very little reason for US yields to go up dramatically. As we can see, from 1993 down, there's a secular downtrend in yields. I think this can continue over the longer period of time. So in the long term, we could hit 0% and maybe go below 0% also. And I would also like to share with you an article which we have written about, if you come to the free services section on our website and come to Color of Money, this is an article that you might want to read, or give them bread or money so that they can eat cake. This actually looks at how economics has evolved over time, and the lack of money is not going to be a constraint to economic growth, is something that uh, has been kind of decided upon, and we now are living in the world of modern monetary theory. So
Okay.
this is something that you might want to look at, which is the kind of forms the bedrock which uh, justifies the secular downtrend in yields. So I hope, does that help you?
Okay. Okay. I will go through that one. Thank you.
Okay. Any more questions? Questions on treasuries? Okay, should I then go on to rupee? I'll take that as an yes to go on to rupee then. In rupee, I was actually supposed to not only share our outlook on the rupee, but something, a very, very strong uh, technical indicator that we use, which we call kiss and divorce. Okay, this is something that we discovered and we used, and we found it to be very powerful. It happens sometimes, but when it happens, then it is very powerful. So I'll just share that with you first, and then we'll talk about the rupee outlook. So this is a 3-day chart, 3-day line chart on the dollar rupee, which means 3-day. Each point is 3 days of market movement. If you look at the blue circles, you find that the price line, which is the blue line, came to a moving average out here, kissed the moving average, and then moved away. So that was the first is the kiss, and then a divorce as the price moves away. So this is a continuation pattern, we would call it. The price comes, kisses the moving average, and then moves away. And that is a very good indicator of strengthening or continuation of a trend. This happened out here, here also. And if that happens, say, suppose with the price and two moving averages, I'll just increase the size a little bit so that everyone can see it. So here you find that it came, the price came to one moving average and second moving average. So there was a kiss between the price and moving average 1 and moving average 2. So that is even more powerful. And the same thing is now, we saw it in a downtrend also out here. The price moved up to moving average, came down, and we saw that happening here. Here again, you saw at say 74.75 in August that the price came up to moving average, and you see the way all of them, all three of them are together, and then the price moved away. So there was a massive decline, and maybe we can see that happen again out here if this moving average holds, and we have a trend line resistance also out here. So if the market remains below 73.75 or 73.80 today, then there can be chances of it coming down. So this is what we were actually supposed to share for a long time. This is what we call a kiss and divorce. This is one example. The same thing we can see on the weekly charts also, a kiss and divorce pattern. When you see a kiss and divorce forming, you can, it's like very powerful. The chances of it going right are in the region of 90% out here. This was a kiss and divorce. Okay, kiss and divorce, kiss and divorce, kiss and divorce, and kiss and divorce, kiss and divorce out here. So this was about kiss and divorce. Any question on this? And then there are chartists also with us today. So anyone would like to have talk about this a little bit? Asutosh is a chartist. I think someone is trying to connect to audio. Otherwise, I'll go on to the next thing on dollar rupee, which is that we have had a good fall in CNY in USD CNY today, and we have a good double top out here. Plus, we have this as a big ABC formation, which has which is confirmed as having got over. So, if we look at this movement from 6.20 in March 20 to 7.18 in September 19 last year, the Fibonacci's of that come to 6.96 that has been broken, 6.82 which has now been broken. The 6.82 has been broken. So next target would be say 6.71 and 6.60. These would be the next targets. 6.71 and 6.60 would be the next targets. We can have possibly a 6.65. Now, if we I'll bring in, if we look at the CNY INR chart, there can be room up to around 11.1 on the monthly chart, because the RBI is through its intervention, it has effectively weakened the rupee against the euro and the yuan. So if we take a target of say 6.71 on USD CNY or 6.65 or 6.60, and we take CNY INR at 11.1, we'll get resultants of 74.51 or 73.82 or 73.27 on dollar rupee. What this tells us is that the upside in dollar rupee might be limited to 74.80 or maybe maximum 74.50, or say maximum about 74.80. The fact that the yuan has really appreciated so much takes away another major factor for possible rupee weakness. We've been talking about lower levels in the long term, and this we might have dollar rupee being limited upside if it is limited to say 74.5 or 74.80, which means these levels. This is the limit for dollar rupee on the upside. Then the downside is more likely. So we're we're projecting say 72 quarters, 71 half initially, and then eventually we would look for levels of say 70 or 69. This is there in our regular monthly projections. So where we have talked about next year is going down to say 69 half by March, and then next year we go up to 71 again. So this was a brief outlook on dollar rupee. Again, open for questions. I wanted to keep this pretty short for everybody, seeing that most of you get the reports on dollar rupee in any case. Again, open for questions. Have I been too fast on this? Have I been audible at least? I hope I've been audible.
Yes, audible.
Okay. So not getting any questions, so I was wondering what's happening.
People might be engaged in engrossed in our information.
Okay. No, but I'm Agarwalji.
I've been looking at your charts, and the earlier in the month when you sent the same benchmark report.
Yes.
About 10 days ago.
Hmm.
One of the factors that I'm not able to grasp is that the potential correction in the stock market, which we are all expecting it ought to have happened, it may happen.
Hmm.
And if and when that happens, isn't that going to impact the dollar rupee negatively?
Very good question. So this is definitely something that has been there ever since March, April. But couple of things. One thing which I have seen or realized over the last several years is that generally, जो as they say कि बिजली एक ही जगह पे दो बार नहीं गिरती है. So a series of same kind of disasters. Of course, 2020 has been, we have had a number of things which have gone wrong, but a repetition immediately of the same disaster might generally does not happen. So if you look at even the great financial crisis, the world actually lived in the shadow of the great financial crisis for more than 10 years. It took almost 10 years for us to get out of and we got out of that, and then when we were getting out of the shadow of the great financial crisis, then 2 years later we've got the COVID. This is one thing. The other is that stock markets, when they climb, there's an old market adage which goes that the market climbs on a wall of worry. So we've been worried about economic recovery ever since March, April, and all our clients know that when we were talking about the markets in April, we said that at the decline of March had already factored in 6 months of economic disruption, and that there were very little chances of stock markets declining further from there. As we have seen thereafter, there's been a V-shaped recovery. We may say, why has it been so? It should not have been like this. The world is the US has been pumping money and the ECB has been pumping money. We may say that, but the fact is that they have pumped in money, and while they are pumping in money, we have that article that I referred to on our website about give them bread so that they can eat cake. No government today is except say India, but in the West, they have gone beyond the printing press, they've gone beyond QE, and they're just going to keep on printing money. Okay, so that part is what has, even if it has led to a much faster V-shaped recovery, it has. That's the fact of the life that we're living with today. Should the stock market now correct? How much will it correct? Is a question which will come up. Will it correct by 10%? If it corrects by 10%, that's par for the course. If it corrects by 20%, that's more worrisome. But only below 20%, more than 20% is where we'll go into a bear market. So how or what will make that happen? That would be if there is another round of lockdowns across the world. So that is something that has been always there since March. That is something we will continue to keep an eye on. That how much it impacts. But if suppose the FOMC today, now FOMC also is very much aware of these things. So suppose they say something today, that over today, tomorrow, that not to worry, nothing's going to happen, we're not going to do anything, and yields actually fall off. Why? We could have another spurt of liquidity. If we have another spurt of liquidity, markets actually go up further. Till they go up to a point where you can't hold a short anymore. That's something that many of us in number have not discounted the possibility of markets actually going up rather than correcting. We've been expecting a correction for the last 6 months. It hasn't happened. We're still hoping for a correction so that we can go in and buy. But have we factored in chances of the market continuing to go up? We have not. I hope that does that help, Manojji?
Yeah, but I don't know whether you follow the Nifty Sensex charts or not, the way you follow currency. The charts give you a very clear indication that the market has to correct. And maybe I'm speaking more than what I'm entitled to. Whether there is a lockdown or no lockdown, there won't be a lockdown. The days of a lockdown have gone by. Even if the government were to announce some kind of a lockdown, they won't be able to enforce it. That thing has come and gone. So let us not link up market reaction, pricing with the lockdown scenario, right? As people looking at charts and as people looking at fundamentals, all this money that is floating in the market, the moment it dries up. So I am of the opinion that between the next 30 days to 120 days, so somewhere from the middle of October to the middle of January, we should start seeing a downward correction in the stock market. Like you rightly said, if it's going to be 10%, that's not here or there. Anything beyond 20% is going to get you into a bear market. And if that trigger happens, then I'm speaking aloud, we may be in for a dramatic fall.
You're absolutely correct, sir.
In which case, all our rupee projections will go all right.
You're absolutely correct. So of the triggers for a protracted decline in the stock market, we've ruled out a lockdown as a possible trigger. Another trigger could be that if there is, as you said, if the money sloshing around in the market suddenly dries up. So what are the chances of money drying up in the market? The Fed and the ECB have gone out and pumped money into the market. They've done that after the GFC. From GFC till today, money has not dried up. And they're going to, this is a given that they're not going to suck out money. They have said that the yields will remain low. My rates are not going to increase for the foreseeable future. Neither the Fed nor the ECB is going to raise rates. This is a given, right? So how can, we'll have to really figure out how money can dry up. There could be another trigger that suppose there's something from on the, say, the Indo-China front or something, and there's something flares up out there and assumes proportions that we would not, none of us would want it to assume. That could be something that we could, that could be a trigger maybe. That is always there. And the threat of a war or something is something that we live with. If that happens, stock markets come down. In any case, there will be a point. You're absolutely 100% right when you say that anytime between the next 30 days to 120 days, the stock market can correct. Yes, the stock market can correct. It will come to a, when all the bears go out of the market is when the stock market will correct. We know that. So when that happens, we figured how much will that impact the rupee. On the upper side, we would now say, see, we've talked about 70, we've kept 74.80, 74.5 as possible upsides on dollar rupee, okay, out here. So that much is accounted for. Do we go beyond that? If we happen to go beyond that, it would be towards, say, 75. The chances of this are in the region of, say, 30% or and not more than that, 75, 73 or so. Are we talking about 78 and 77, 78, 80? Now the chances of that have reduced compared to, say, March, April or May, that we market we were talking about it. That has certainly reduced today.
I was keen to wanting to listen to what Ghanshyam Bhai has to say about this. He's a very close follower of the market.
Yes, of course.
Ghanshyam, आप हैं वहाँ पर?
Ghanshyam ji, would you like to comment? Or Asutosh or...
Hi, thank you, sir. Thank you so much. But no, I do not have too much to add at this point of time because my thought process is very much on the same page that you're coming from, Manoj. But I have been proven wrong over the last 3 months, wherein the fundamentals have been completely discounted by the markets. And rupee has been appreciating. So now I have come to a point where I'm made to believe that that kind of a lag or a disconnect can remain for longer period also. So the points what Vikramji is pointing out to right now, that the triggers that we would have to look for is the kind of indications from all the central bankers where the liquidity winding up is happening or is likely seen on the horizon. That could be the first trigger that I would want to watch very keenly. And apart from that, it's the Indo-China geopolitical issue. But other than that, it looks like that the liquid money can push up stocks for longer period than what we think.
And what is the likely impact of the 6th of November, 6th or 7th, whatever that date is, the D-date?
For the elections, is it?
American election.
The
What happens when Trump loses?
Yeah, that is a very important thing which you are bringing up, Rajalji. What we have seen is that when basically the Democrat presidencies have coincided with dollar weakness and Republican presidencies have coincided with dollar weakness and Democrats with dollar strength. So in case Biden comes in and Trump loses, that could lead to a decline in the euro and an increase in the dollar index, and that could take dollar rupee up.
Sir, but will it not at the same time start looking positive on the global GDPs because the kind of issues Mr. Trump has brought about on the geopolitical horizon, that will all be eased out.
So that is
the situation between US, China, that will start easing out.
Correct. So that's the foil for that. That's the counterbalance for that. So that is something that we...
Lekin Ghanshyam, that won't happen for a long time because in the USA, the presidency takes over only after 2.5 months.
So, but market starts to discounting the event
market will
right
start
from
reacting.
the offset. Yes.
Yeah. Market will start reacting to the potential change.
Yes.
Because the two parties, unlike in our country, they have very distinct and very sharp opinions and action points. हमारे यहाँ तो अधिकारी देश चलाता है, वहाँ अधिकारी नहीं चलाता.
G. So, but that's a counterbalance that can be brought about. And I don't know if I am the right person to comment on it. That is something which we would have to take with a pinch of salt as and when it happens. How the bigger players of the market think of the world for the next 2-3 years, and what kind of positions they start to building up.
Any more questions, gentlemen, ladies, on Crude or Treasury or anything else? And thank you so much for your participation.
Vikramji, thank you so much. Just one more thing. What is the kind of level do you have on mind where you would start believing that, okay, there is no more appreciation beyond this point on the rupee front?
We have allowed for 69.5, 68.5, also on dollar by March.
Wow.
Okay, so
that is
सुनाई नहीं देता.
Sorry?
That is such a number that, सुन के भी सुनाई नहीं देता.
Okay, we may not, of course it sounds a little outlandish today, but say I would look for 70 at C. So now we know that we would already have been at these levels at the RBI allowed it. Now what we've seen on this in this calculation is the upside that this tells us that the upside could be limited to 74.5, right? So if we limit the upside to 74.5 and then we come to a dollar rupee chart, then on the chart, then even then 68 does not look to be such an outlandish thing.
But then in that case, what happens with RBI's balance sheets and the kind of dividends related to it?
Yeah, so that is the issue that the RBI, I mean, either the RBI changes its stance or we don't get 68. Or it could also happen that, say, suppose Trump actually loses and the bid end comes in, then we don't go below 71, then we would have to look for this.
And the stop loss to all of this would still be the same 74, 40, 50 sort of level.
Yeah, and of course we'll keep looking at other things like where is the euro going? Is it falling below 1.15 or not? Is it not going up above 1.20, 1.21 or not? What is the US Treasury going above 1.70? Is crude falling below 35? Those will be the supporting things which will give us advance warning.
Right, sir.
Anyone else? Please.
Mr.
Nitin, Mukesh, Karishma ji, anyone else? Asutosh, Mr. Aman Rao, any questions?
There are questions coming on your chat box, Vikram.
1 second, let me just see that. What if Trump causes transition issues? Yeah, so that is something that we'll have to see. Those are things we don't have an indication of right now. Whether Trump will be there or whether Biden will be there right now. On that, the only thing we can say is that popularity ratings of Biden are far outweigh that of Trump. But Trump is again gaining a little bit and Biden is losing ground a little. That's the only thing that we can say. What transition issues will be there or not, we are unable to say right now. But as I said, there will be indications in the market. Does the US Treasury 30-year go above 1.7? Does the 10-year go above 1%? Does euro decline below 1.15? Does the stock market fall more than 10%? These are things that we will come to. We will have enough indications on these as time goes by. So we'll be able to answer for our purposes, there ought to be hopefully enough warnings. We don't know what transition issues will be there. Does that help you, Mukesh?
Yes. I understand what you're saying, but my guess is globally there has to be a value. You start putting to a scenario where Trump refuses to, the US goes into turmoil and chaos.
If he refuses to accept the election results, is it?
Yes. I mean, that's a very, very likely scenario now coming up.
Okay.
He has already started talking of a third term, leave alone a second term.
Okay, so that is something, that is an interesting point that you bring up.
Yeah, so that's a likely sort of a shock.
That happens, yes, definitely. We have to be very, very careful if something like that happens.
Vikramji,
Haan ji.
Actually, in this, actually, we are not talking about the what is the vaccination, because we are not at all planned about this. In case that vaccine is means it was came out in early. What is the global recovery and what about the Indian point of view?
The maybe the only thing that I can think of on that is that markets are possibly built in a more optimistic idea about vaccination. And what we're seeing that there's been a pause from AstraZeneca and from at Oxford, etc. So to that extent, the markets could give back, the stock market could give back a little value. That could be something that happens on the vaccination front. That is the only thing that comes to my mind. Anyone else would like to add to that? Who was more informed on that, please do feel free to join in. Anyone? And Mr. Rao, does that help you? I mean, Rao, does my answer help you out? No? So with this, maybe we'll call this to a close today. Thank you so much, everybody, for coming in.
Vikramji, one more request.
Yes, please.
Can we have more often?
I would be very happy, and I just hope we do it a little better than what we've done today about the. We'll try and do it a little more than the confusion about the
today also has been very enlightening. But if we have this more consistently, then the factors that you work on the background can be more connected to.
Absolutely.
And we can have more conviction on what we are discussing.
Of course, we can have that more often.
And plus giving us a chance to interact with each other as well.
Of course.
Absolutely.
In fact, I've been thinking that not only should we interact on the market outlook, we should possibly interact commonly on hedging principles, about hedging techniques and hedging tactics and what goes into making a good hedging program. That is something that I have in mind. If you agree to that, that is something I would really love to do.
We are okay with that, and in case our hedging policies are being discussed openly, because you would have perspective on different organizations' hedging policies, and that could help us all change where we need to or modify where things can be improved.
And my idea would not be to talk about intrude on the privacy and confidentiality of any company, but about hedging principles in general, which are helpful to everybody, and everybody can share those experiences. That
look forward.
On the system side, I know that Agarwalji is very strong on his system side, on his information database, and Ghanshyamji is makes use of options also. So those things which are common to everybody, apart from the policy as such, keeping confidentiality in mind, and of course, it would not be for me to disclose anybody's internal workings. And to the extent that we all want to share to help each other on the hedging techniques and principles.
Great.
Okay. Sure. Thank you so much, everybody. I really appreciate you having come in, and we'll try and do more of these. Thank you very much. With this, I'll end the session for everybody. Thank you.